Good morning. Thank you to be here for this seminar. We are very happy to have here Professor David Porter. He's a friend of Instituto. He was here also in the past. I remember him in Festival for this seminar. And it's very interesting. It comes from Chapman University, California. And this month we have another professor from the same university, Abel Wynn. He spoke about eminent domain. Apparently, it seems a totally different topic. Not really, because both are in the same research program, because they are economists in experimental economy. And it's a very important area for the institute. We have published many papers of this tradition, and part also important book by Professor Werner Smith, Rationality and Economics, we translated in Italian. And the topic is, in my opinion, I'm not an economist, I'm a political philosopher, anyway very, very interesting, because in the public discussion, high-frequency trading is often attacked, because it accuses the origin of extreme volatility and the origin too much complexity of the market, and it's something which can destabilize the market, etc. So when we speak about high-frequency trading, normally we ask regulation. And the institute, as you know, is an institute defending property rights, free market, so there is an important link between this topic and what is the purpose of our activity to protect the free market and individual people. So I finish my very, very short presentation. I'm very happy. I thank David to be here.
Well, it's a pleasure to be here. Go slowly. If you don't understand any word, we have a translator. So if you just look at the topic, so high frequency trading, I will tell you what that is. Market quality, I will tell you what that is. And experimental markets, I will tell you what that is. Okay, so you don't need to know any of those things. That's just for the academic audience that okay, now I got you. But Carlo did a fantastic job of telling you about high frequency trading. It's something right now that is attacked on a basis. Every time there's something wrong in the market, volatility, crashes, whatever, it's because of this origin. And I will tell you how it came about, why it's there. Usually, the high frequency trading came about because of government regulation. That'll be the interesting part, let's see. So if there's something you don't understand, please stop me. Anytime, ask a question. I don't want to leave anybody behind, okay? Hopefully this will do it. This is the first time I presented this paper, so your feedback will actually be very helpful. This paper was an actual master's thesis by Nathaniel Berger, and he was very interested in this after we talked about it in class, so he did all the work, and I just put my name on it. So now we'll open it up and see what we did together, okay? Okay, so what I'm going to tell you about is, this is the outline of the talk. So has anybody read the book Flash Boys? Okay, so that's where he did it. He read this book and he said, this doesn't seem right to me, okay? So I'm going to tell a little bit of the story about Flash Boys, Michael Lewis. So very famous, you know, he wrote Liar's Poker, Moneyball, you know, all those books. So he's a fantastic writer. He always has to have a story with, you know, a hero and an antagonist. And he has this here, and so he loves it, okay? Then I'll tell you what high frequency trading is, how it came about, how it might affect markets, especially asset markets, you know, stock markets, and foreign exchange markets. And then I'm going to use a controlled experiment. I'll tell you more detail about it and what it means to be a controlled experiment to examine the effects, because it's very hard to determine what the effects of high frequency trading is, because everything else is changing at the same time, so you don't know what the origin of this problem might be that the regulators think they have. Many kinds of debt, okay, and they don't even know. And then I'll give you a summary. All right, so here's the Flash Boys story. So the book starts with this picture. So it's a black fiber optic line that this company, Spread Networks, decided to put from the exchange in New York, BATS, to the futures exchange in Chicago. Okay, so that's the blue line. They wanted to make this as straight as possible to eliminate any lag in the transmission of the data. Okay, and it's a long. This chapter is very long. And you're looking at it's an amazing little story about how they would come to get all the rights to do this, and they would come to an intersection where they couldn't go up to the middle, so they had to minimize any bend in the fiber optic to. Okay, so this is when they built this to be the first one to be able to see a price difference in the spot market versus the futures market. So you can see a difference between those. You could arbitrage, right? So you could buy here and sell here and make money risk-free. Well, they built this spread network and they sold the ability to be part of spread networks. And they were selling it for, 200,000 at the end plus, 200,000 a month. And somebody said, well, can I pay more so that nobody else can use it, right? So there's some value in this for being first, okay? Because there's always discrepancies in the market. Now, a lot of people will say, well, a lot of people, the regulators said this was a waste of resources. It's very expensive to do this for a millisecond, okay? Well, it turns out it's not for these guys, right? Because now they're going to they want to be the first. Arbitrage is not a bad thing. It's going to equate the prices and so forth. But anyway, that was the story. So it's amazing, okay? Right now, this is obsolete because now they have the microwaves that go through. So, but anyway, for a time, this was the thing to do. So this was using milliseconds. So it's 827 miles of dark optic fiber from the futures and options to NASDAQ. Right? It costs $300 million to build this network. Okay, it allows for about a millisecond to 1.5 milliseconds round trip advantage. You're in front of somebody that's less than the blink of an eye. Okay, that's how fast you have to be. Okay, when was this? So this was done in 7, I think, when they finished. I'm glad he's here. Oh, this is excellent.
I've been reading that book.
Yeah,
it's amazing. Also, Dark Pools.
Yes, right. Very
interesting. Yeah.
So I think it's 2007 when they finished. 2006 when they were having all their issues. But okay. The remainder of this book talks about this fellow Brad Katsuyama, who's at the Bank of Canada. Okay. And Brad he's noticing that if he's sitting there on his machine. Okay, he sees an order. He can buy it 20.05. Okay, when he presses his button, he actually executes at 2. As he presses, the price went a penny higher, and he wondered how this could happen. And this is the whole story of Michael Lewis. So he wanted to find out how this happened. Well, Brad did. So he had all these technicians find out. And Lewis concludes that the markets are rigged, right? That's where my students said, well, I don't, the guys are just doing what you would do if you could, right? Anyway. So what's HFT? So here's a picture that might tell you a story about HFT. So 1932, that's what the New York Stock Exchange floor looks like. 2007, there's nobody on the floor. Okay, there's no such trading. It's all electronic. Okay, so. That's what, so there's a topic called algorithmic trading. That means trading is done by the computers. It's not done by humans. So programs execute the trades. They're pretty simple sometimes, like, if it's above 60, put in a buy order a little bit or whatever. There's others known as high-frequency trading, which are a little more sophisticated. These require you to find out where you are, which exchange these are likely to go to, and to trigger your position in a millisecond. Buy stuff, just like that. Okay, I'll try to explain how it gets done. So there are what they do is they evaluate the market prices in real time, so they're seeing them coming in. And probabilistically, they find out, oh, this is going to be a bigger order, it's going to have to be routed somewhere else. So let me get in front of that, okay? Now, these high-frequency traders do two things. They write very sophisticated programs, and the other thing they do is something called co-location. So just like I was telling you about that network that was built so that they could get a, millisecond advantage, the closer your computer is to the exchange, the sooner you're going to be there before anybody else, okay? So they pay lots of money to the exchanges to be co-located, okay? So the exchanges love high-frequency traders, okay? So here it is. About 85% of all trades on the New York Stock Exchange are done by computers, okay? No humans involved, okay? That's not high-frequency trading, that's just algorithmic trading. Okay, so there's a paper, cited paper, very recent, that on average, high-frequency trading accounts for about 10 to 40% of all the trading volume on all equity exchanges, and about 10% or so on the foreign exchange and commodities. That's a large amount. Okay? But it's not clear what the difference between algorithmic trading and high-frequency trading. So let me set the stage here for this. Okay, so there's no universal term for high frequency trading, but in general, a high frequency trader is somebody who uses the speed of the networks, clears his position immediately. He's never holding. By the end of the day, he's never holding anything except the cash that he made. They co-locate the services, they have individual data feeds. So they're trying to speed up the process. They put in lots of orders quickly and move them, just like fishing. They're throwing the bait in there to see who's out there. And that's their task, okay? It's getting harder and harder because why? There's more high frequency traders, there's different algorithms for doing this. But this is sort of, someone looks at this. There's a paper called the arms race for speed. And so most people see this as a waste of resources. This money to get a millisecond advantage, how could that be of any concern? Well, it turns out that these guys offer lots of things. They offer liquidity. More importantly, they have reduced transaction fees. So they account for a large volume, okay? They have doubled the volume on the exchanges since they've started, doubled it. Okay, that means the fees that the exchanges are getting are going up, and so they're cutting their fees to compete. So the basic trader is now getting the advantage of this, because the high frequency guys are trading a lot.
Do you reckon this is true liquidity or
no? It's
fake liquidity.
Well, that's a great. I don't know what liquidity is. Okay,
yeah.
It's an ill-defined term. It makes no sense to me. I mean, if you talk to somebody in finance, you will, if they want you to shut up, they'll say, well, liquidity. And yeah, liquidity. So I asked them, well, what is this? Well, it's the ability to trade quickly with, okay, well, you can do that. I can trade really quickly, just put in a higher price, without moving the price. Without moving the price, you want the prices to move. I mean, if they never move, what are you going to learn from that? So the question of liquidity is, Maureen O'Hara said it best. He says, liquidity is like pornography, or you know it when you see it. And so I've never seen it, personally. So it's fake liquidity in the sense that, do you need to trade that fast? Well, it turns out that if you're a trader, you don't need to do this. Other places you can go that, if you think you're being taken advantage of, you don't need to do this. Okay, you can just put in a limit order. Okay, you can go to a dark pool. You can go to a crossing network. But all these guys want to trade now. Now, why they want to do that, I don't know. I could not tell you that. I talked to them. I still don't know. Okay, but if that's what they want, what are you going to do? Okay.
So you don't think it's an unfair advantage to give them a location that is closer to the market compared to the other operators. At the end of the day, the market and the exchanges, I think they have to maintain a level playing field among all the operators. It's like selling information to them before to all the others.
Okay, that's fine. But if you're a trader, every trader knows this is going on. It's not like they've read the book, okay? Everybody knows this is going on. There are exchanges out there that are crossing networks. That means everybody trades at the same time, okay? You can send your order there. Not very many people do. They send it here, okay? So if you think it's an unfair advantage, then don't send it there, okay? But it's providing them something. Immediate transactions so they can move on. They can balance their portfolio. When you send it to another exchange, like a dark pool, which is basically everybody sends it, you don't know anything about it. You just send in your order and hope something happens. Well, if you don't trade, and that was part of your task is to trade, and it comes back, well, you didn't make a trade. Well, hold it, what am I going to do? I got to send it now to another dark pool. So they want to get the trade and move on. And we're talking about every trade that these high-frequency traders are involved in are tenths of a penny, okay? Now, a tenth of a penny over billions of shares, you know, sort of make money. But you as a trader, are you willing to pay a tenth of a penny more on your trade to get it executed right now, or would you like to send it to a dark pool and see what happens? Well, they're obviously telling you what they want, okay? So if you're saying, oh, I paid more to be in the front of the line, so these guys are paying to be the ones that execute that trade, that liquidity, okay, whatever you might call it. So I don't know if when you say unfair advantage, you know, how about people who are hiring the best people to do the algorithms for them? That's an unfair advantage.
No, I mean, the exchange is not supposed to sell information to someone.
They're not selling information.
But it's selling the location. At the end of the day, it's like selling information before the others. Then you can say, okay, it's just a millisecond, but that millisecond makes this guy very rich at the expense of the other operators. And you're talking about reduction in transaction fees. This is true. But if they make money, there is a kind of hidden cost for all the other operators to operate in that exchange. It's not that it's a zero-sum game.
It's certainly not a zero-sum game, right? Because the person who's sending in the order, right? If you do not want to be taken advantage of, then don't send in a market order, okay?
Yeah, all it doesn't mean to send a market order. I put a limit order. Also, in putting limit orders, I can have a disadvantage because my order is not executed because the price doesn't get in that limit. I mean, the only thing I know is that.
But they're always making that particular argument, right? So if I send in my order and I want it executed, do I care whether it's executed by an HFT or somebody else? I mean, is this a voluntary exchange? Okay, so it's very hard to say.
Now, I don't want to interject too much.
No, that's fine.
It's just that, I mean, if you think about the purpose of an exchange, it's basically allowing everyone in a fair way to basically deal. If the exchange in itself sells this information or puts someone of the operator in a best position versus the other,
okay,
it's not.
So I would agree with you under the following condition.
Yeah.
The one thing is, there's not one exchange. There's 17 exchanges.
Yeah, every single exchange says co-location.
No. Brad Katsuyama has a one where you don't have co-location. There are crossing networks that have nothing to do with co-location. You just send in your orders and they cross. So there's lots of competition that exists out there. Okay, so if you think, oh, I'm providing this benefit to somebody else. Let's be clear about what an exchange does. An exchange is there to make money. Okay, it's not there to provide a level playing field or whatever unless it makes them money. So Brad Katsuyama did that. He thought, oh, it's not a level playing field. Let me create my own exchange. Well, he doesn't have very many people going there. So obviously he's not providing something that these other exchanges are providing. So you can, they do it all the time, okay? the exchanges overlooking into it, you know, when all the SEC is looking into it. But they check their customers, and people are still coming there, you know. But I'm not discounting the fact that you know, they're putting these things there, and there's a reason to be there to get that extra penny. But they're also doing lots of trading, okay? And so nobody knows what the effect of these things are. That's the whole purpose of this. That's why I did this study. So, and here I only have one exchange. I don't even have the exchanges competing. So I'm going to give it its best chance. So let's revisit that in a minute, okay? And I don't know if I'm, you know, providing, I'm not trying to be argumentative in any sense here. I just don't know how to answer that question, okay?
Okay.
All right. So here it is. How did HFT actually start? So it turns out it started because the market got fragmented. So there's something called Reg NMS. This is the regulation. In 2005, the SEC, to enhance competition and unite the fragmented market. So there are 11 major equity exchanges, 50 more alternative trading platforms that are out there. So there's lots of competition in that sense. So there's something called the trade-through rule. There's a lot of exchanges out there, and they're all posting a bid-ask spread. Okay, so an ask to sell, a bid to buy, and they're all over the place. You set it in order. Okay. The rule here is, as the broker, as the system, or whatever, you must route that order to where it's best, where it can best execute. I mean, where its best price is. So if there's a buy, if you're sending in a buy order, and there's a sell here for 10 and a sell here for 9, it's going to route you over here. Okay, it's going to make sure you try to get the 9. Well, the problem with that is, if the HFT guy knows that you will be routed over here, what can he do? If he can get in front of you, right, then he can post something that's a little better for him, right, than the 9 that was there. So because of the fragmentation and because of this rule, HFT started. That's how the HFT started. It didn't start because of, you know, some Russian guy in the back room. It's because of this rule here. And so because of that, so this is the pre-fragmentation. Investors would go to the intermediaries or directly to the over-the-counter. You see the visible book, and there'll be a primary deal. That's it. You see it, make your execution. Here, there's HFT, there's investors, there's dark pools, there's crossing engines, and they all filter down to cross all these exchanges. Well, the HFT just goes around them. Okay, it doesn't go through the loop like everybody else is doing. Right? So it sees where it thinks the order's going. So it'll send out an order. Maybe this picture's better. Okay, an order's placed. The HFT notices the order cannot be exchanged totally at that spot, right? It's too big an order. So it's going to have to route some of that order somewhere else. Oh, it notices that because it's been sending out little orders, right? It notices this probabilistically. It buys the rest. It goes to the exchange where this one's going to have to be routed because of the best bid and offer. It then buys and then resells, okay? So it goes within the spread. So that's how he makes the money. He gets there before the other person's order gets there. There's ways around it. You can say, I want all my order filled at that exchange. So don't reroute it if that's what you want to do, okay? Likely it would cost more because you're going to go deeper into that book, if that makes sense to everybody. So that's how it gets rerouted, and then they sit there and take care of it, okay? Does this make sense to everybody? Is this sort of crystal clear? Because this is how it gets done. This is how the HFT operates, okay? So is HFT a bad thing? That's sort of where we're at right now. Regulators have claimed that HFT contributed to this crash. Who knows? Italy believes that the HFT is a bad thing. They're the first country to impose a tax. Normal.
There's taxes on everything.
Yeah, so it's 0.2% on any transaction that lasts less than half a second. Okay, so if you buy and then you resell quickly, you get taxed. Okay, that's the story here. So that's where we started. Is it a bad thing? Or at least that's where Nathaniel started. And so he wanted to know what that meant. So most academic studies somehow show, that HFT actually improves the markets. There doesn't seem to be anything that's destabilizing. It has an incremental effect on, reducing transaction fees. These are all stories, but the problem here is you never know where that came from. Could be competition among the exchanges, could be just actual volume increasing. So there's no way that one can figure out without the counterfactual, which is why we do an experiment. That's the whole purpose of the experiment. We're going to see this in a controlled setting. So most of the academic studies can't find anything. Okay. In fact, they find positive results, but they don't know why. Quite honestly, they just don't know why. Now they say, oh, it improves quality. Bid-ask spreads are getting tighter and whatever that means. So if they're making bid-ask spreads tighter, that means there's less room for the HFT to make money, right? I mean, now they're down to tenths of pennies, Okay. So we're going to use economic experiments to determine the effect of HFT. So for those who don't know what an experiment is, I'll try to explain it to you. Okay. So this goes way back. The very first experiment was done in 1956. Well, the first, actually before that, but that was, for a study, for actual publication. So Vernon did it in 1956. And so if you ever open up an economics textbook, it'll say that economics is an observational science and not an experimental science, right? We just see what happens and we look at it. So Vernon suggests that doesn't sound right too. So what you do is you bring actual humans into a laboratory and you put them in a role. They don't know it's a role, of buying, selling, whatever. And they may be told, for example, if you're a buyer, there's this item and it's worth $10 to you, literally $10. I will pay you $10 if you purchase this. But you must pay the price of however you purchased it. The difference between that value, $10, and whatever you pay for it, literal money, right? You pay them money, cash, at the end of the experiment. So they're cash motivated, okay? And as long as people enjoy money, and if you don't, please see me after the talk. I can help you increase your utility by giving you some euros. So please take it gladly. So their job is to maximize the buyer, maximize the difference between the value we told them it is to them and what they pay. So then want the price as low as possible. On the other hand, there's a seller who's told you have this item and it costs you $5 to produce. It's worth $5 to you, but you own it. If you're going to sell it, you better sell it for more than $5. Right? So you get the difference between the price you sold it at and the cost. Right, so it's fine. So if you have somebody who values it at 10 and 5, there's a lot of room for negotiation and so on. So that's what we do. There's many different types of experiments. I just give you the overview of the one that I'm trying to do here. Okay. So we're going to create this environment with payoffs in it, and we're going to test whether market quality, which I'll define in detail here, or efficiency of the market, whether it, whether these HFT we're going to put in an algorithmic trader who's perfectly informed, not probabilistic, perfectly. So this is the best case to find if there's an issue with HFT. We're going to create software that implements the rules of the current stock exchanges, and we're going to put latency in to foster the HFT. So there's a delay by the time you press your order and something happens. We can't do it in milliseconds because these are humans, and they don't work on the millisecond level, so they work at the 3-second level. But I'll give you more detail there. Okay, so buyers are provided what I just told you, this is resale value. Their profit is the value minus the price paid. So this is sort of what one of the, each period, this thing will change. But basically in the period, somebody who's a buyer is going to be given a value, say, of 140. I think that was $14 or $1.40, I can't remember. They're told that's what that's worth to them. They might also get another value at 110, another one down here at 80. So they have a list of orders from their customers. and this is the most they're willing to pay. And if you can get better than that, you get to keep it. Okay, so these are the orders that they can try and do better. Okay, so this creates a demand curve, right? So the highest value guys should be traded first and so forth, right? All the way down. Is everybody with me? See? Okay. On the other hand, we have sellers and we provide them costs. So down here, 60 and so forth, all the way up. So one seller might have a value cost at 60, another at 100, another unit at 120. So he has his own supply curve that he's trying to implement. Okay. He may not get them all implemented, but this is the way he's going to make money, and it's the price he got by selling minus the cost. If you put them both together, you have supply and demand. Okay. And so in this particular case, the predictions here would be that the price should be at 100 and 25 units should be traded. Okay, something like anywhere from 20 to 25. Right, so it's right there, this flat bar. So that's a prediction. And then there's this term called efficiency. Does anybody know what that is? So how efficient the market is. So efficiency is how much surplus can be pulled out of the market. Okay. Can you do any better than that? So if you look at it, it's the usual story, right? This area between the values and the costs in here, this area is the best you can get, okay? So the difference between these values and these costs, because anything over there is going to reduce the values here, right? Because they're below, and these guys right here, if they were to trade, they're going to display somebody with a higher value. So we take this area, and then when we run an experiment, we see what actually occurred and how far did they get relative to this total area of surplus. This is the best that the market can do. It's the best that anybody can do in terms of generating as much surplus as possible. Does everybody get that? So that's another measure. So we do more because, of course, we can. Now this is going to look odd, but it isn't. Okay, so on the demand side, remember I showed you the demand curve. So if I go back up here, one more, starts at 140 and so forth. So that's where that 140, 130 come. There's 5 units at 140, there's another 5 at 130 and so forth. And we're going to randomly assign these values to individuals. And each period, we're going to draw them anew. So you run a period, you do all your trading, and now we're going to start the second period, and we shift everything. The individuals don't know this. This is what we're doing. So we shift the values and then randomize them across everybody between minus 50 and 50. So these curves are shifting up and down in unison. So nothing is really changing. So if I go back one, I'm sorry. Where did I go? Oh, all the way to the conclusions. Okay, well that's okay. Sorry, I hit the wrong button. Okay. I'm almost back. Oh, there we go. So each period, these are going to shift up and down. These are going to shift up and down, but the curves are going to look the same. It's just that they move, the price is going to move. So from the subject's point of view, they think the world is changing, right? So, but we've kept steady. So we want to see, does it change over time? We want to know that if it moves, how fast do the markets react? Because the price is going to have to move up by that X amount or down, depending on how we shift it, right? So it's being shifted by the same amount. Is everybody with me?
Yeah.
See?
But this is in the same round of the experiment.
Yeah, so great question. So period one, they come in.
You
And
start
it looks like that.
Yeah.
Right, so you might be there and you look at your screen. This is at a value 140. My first unit is 140, my next is 130, my next is 80, so forth. And you see that on your screen and you're gonna try to execute the orders in that. You certainly want to get your best ones done first, right? The next period, so you do that, you trade and you get your account, you get your money in your account, you see it changing. The next period, you look at your screen, it says, oh, you have a value of 165, another at 35. So it looks like the world has changed to you.
Yeah.
But it really, the underlying hasn't changed. You have changed, but the underlying world hasn't changed. It's just been shifted up or down. Does that make
So
sense?
the structure of the supply demand curve.
Yeah. And so the structure is the same, it's just shifted up and down. And so you start the next period and you trade again. Does that make sense? And we're going to do that, I don't know how many times, we're going to find out. At least 10, I know, maybe 17.
So X is the same
For everything.
the period is the same for all the units.
For all the units, it's just that you don't know that. You're going to get randomized. So it's so that we do see it. So this curve, let's say it goes up by, let's say 50. Okay. So the top number is now going to be 190. Okay. And the next one down there is 180. Okay, and so forth. And you're going to get some of these values drawn random. You don't know which ones, but so your curve looks like they're moving. You're getting new stuff every time in 2 dimensions. It's moving, the values are moving, but they're all being shifted, and you're getting different ones. So from your perspective, you're thinking, wow, okay, new values, let me trade. Does that make sense? Maybe the screen might help. And the suppliers have the same thing, right? So this is what should happen. So this is the non-stationary equilibrium. So these are that should be occurring each period to clear the market. So they start down here at 70 and then they go up here to 150. So they're moving up and around each period. So it looks like a volatile market each period in the sense that prices should be moving to reach that equilibrium. Okay. So we have 2 treatments, 2 simple things we're going to do. We have the baseline, which we have 8 sessions of 20 periods. The first 2 periods are unpaid practice, so they can learn how to use the software. And subjects were confronted with a 3-second time limit. So when you send in your order, it doesn't hit the market for 3 seconds. Okay. So what you see on the screen is the current bid-ask spread, not what's going to happen. Yours is going to be 3 seconds later than that. Okay. Then we have an HFT treatment with 8 sessions composed of 20 periods with 2 unpaid practice, same as that. But we have an algorithm in there that if you send in a market order, it's going to act as the middleman, and it's going to use its speed advantage to arbitrage. Okay, and so this is this is the implementing of the risk-free. The ones in the real world are not risk-free; they're all probabilistic. You don't know what that order really is. You don't know how deep it is. You just have a probability that it's of that type. Here you know precisely. Okay, that's the HFT, and you're going to front run. Okay. Front run meaning you're going to go in front of that order and make a difference. Okay. So this is how it works. Okay. So this is the arbitrage algorithm that looks like. The seller submits a new ask order lower than the standing bid. So if he's sending one in, and he sends in an order to sell at 33, you'll notice that the current book has a 40 to sell and a 35 to buy. So if you send in an order at 33, it will get executed at 35, right? If this were the, if you were a meeting, okay? But it's going to take some time to do that. So this order is added to the queue. You can see it in there, right? You still see the ask at 40. The HFT then does what? Well, it looks at that spread and sees, oh, I've got some time advantage in it. And I'm going to take that 33 and I'm going to sell at 35. So I'm going to make 2, right? That's what it's going to do. That's all it does. Okay? Now, here's the thing. The guy who sent in the order at 33 was going to get executed at that limit order. What was he going to buy at? He's going to buy at 35. Okay? Well, instead of the 35 guy getting it, the HFT does that. So the guy who sent in the order, he's getting 35. The only person that didn't get the 35 is the, well, he's going to do a little less than, he's going to do, well, what's he going to do? He's going to do a little bit better than it, right? So he's going to, HFT sells for 35. He's just going to go a little bit above it, right? So think about that. So, let me see here. He's going to try and get as much as he can in between those 2, right? So he's going to go and the order that came at 33, he's going to take it and then he's going to resell 35. Okay. So who got hurt here? I'm not quite sure, right? You know, the story is I was going to put in 33. I put in 33.
When you say putting 33, you're not putting a limit order. You just see 33.
Mm-hmm. This guy did. So if we go back, let me see which is back up here. So originally, this guy, somebody selling it is going to sell it, wants to sell at 33. Okay, he's sending in the limit order. Now he's delayed, right? So he's just sending in 33. Limit order. He could send in 35, right? But he wants to make sure the market could move, so he puts in a 33.
So he doesn't see 35 when he puts 33.
No, he sees 35. He sees 35, but he knows there's a 3-second delay. So, right? So in the meantime, the HFT sees the 33. Right? So if you saw the 33, what do?
So he sees that it disappears from
I sell at 33. Okay? He wanted to sell at 30. I sell at 33. I mean, I buy it. He wants to sell at 33, so I do it. I buy that, and then I sell back at 35. Okay. We wanted 33. We had 33. We didn't want 33. We shouldn't put it at 33. Anyway, that's what happens. Okay.
Technically, would this sell the HFT would sell first at 35 and then buy back at 33 to the original seller?
No, what he would do is he would take the 33, right? Well, how does he do this, right? He goes in, right, he sucks up that order. So he sees this one in here. What is he going to do? You're correct.
He's going to first sell at 35 and then
and then buy back at 33. Exactly. Exactly.
That's the way it works.
That's the way it works. Thank you. See, I have him here to make sure that it's clear.
No, I've been against them for a few months.
I see, I got you.
So basically, I see the order book at 35, but I cannot hit the 33.
No, but the HFT can. Well, he gets the 35 and sells right. So he sells at 35 and buys at 33. Exactly. There he is. You know, he did his job. He becomes a standing order, and we're done. Okay. So here's front running a market order. So the market order is even worse. Okay. So now you're sitting here, and you say, I see 35. I want to buy at 35. Right? I'm a buyer. I see this market order here, and I said, okay, let me buy at 35. Okay. So that market order of 35 is sent to the market. Well, let's see. The HFT does what? Well, he sees, that means it's a market order to buy. So what he can do is go in front of it.
Takes a 40 and sells.
Right. Sells it in between the next one up. Right? So he says, I'll buy at 40, and now I'll repost just below the guy below him, right? Which is at 44.9. So now he's at the top of the book, right? And that's how he does it. Now, the HFT, if these books are thick, and there's not much to be made between, you know, that sort of the story. There's not much going on there. If the next order in the book is also at 40, you got to keep going up the book, right?
But I read something about this. There are some exchanges like BATS, probably, the ATS, that allow the HFT firms to put specific types of orders in the book.
Yes.
That actually recites them like phantoms, like ghosts, and then appear when the market flashes it.
That's correct.
That sounds a bit tricky.
Yes.
Cheating.
Well,
sense. I don't know. I don't want to discuss about.
No, there's all kinds of market orders that you can put in.
I mean, they're allowed to make sure profit because, you know, when they're hitting the offers, they will do it just in the right time when the book has the correct size and the correct timing.
So they're called phantom orders.
Yeah.
Okay. But on the other
jump
side,
the line. That's what Ian Bodek noticed.
Yeah. But if you're somebody sending in this order, you can send in iceberg orders. You can try to counterfeit.
I never place market orders.
Right.
So
there are other things you can do on the other side to combat this. But it's true. If you open up, BATS is the worst. So BATS has the number of types of orders you can put in. It's like the book is this thick. Some of them I don't even understand when you read them. Like What is that order?
Yeah.
So there's the phantom orders, there's the, ghost orders.
Yeah, so you at the cinema, a movie theater, trying to buy tickets, and then someone just jumps in line in front of you, and you don't have any seats for you.
It's true, but the best bid and offer order, that would be like saying, oh, the 35 that's out there is a phantom order. That's not me. That's the guy who just put one in there. But if everybody's around that, it's very hard to do. The book is very thick, right?
It's crowded.
Right. Yeah. But anyway, this is how this algorithm works. Okay, so I agree with you. We didn't allow any of those, but it almost looks like that, right? I mean, these guys are risk-free, no problem. Okay. So again, bought at 40, we sell at 40. There it is, 44. Okay. So here's some other details from the experiment. The instructions were the same for both treatments. Subjects were deliberately not informed about the presence of an HFT, which is, you're doing trading. So there will be no difference between the two treatments that are endogenous. So there's an HFT in there. We're going to see whether they can figure that out or see that they're losing money or making money or whatever it is that they're doing by not even know that there's an algorithm to trade involved. Okay. There's examples, and they're aware of the uncertainty that comes with the time delay. In other words, these are the kind of things that might happen to you with time delay. Okay. Is everybody with me? Okay.
Do you think that it could have created difference to know that there is the presence of HFT?
Yeah, I think so, yes.
And so why you wanted to?
Because, okay, the main reason is we didn't want any other noise in there other than the fact that there was an algorithm. So the two treatments I wanted to look almost, I wanted them to be identical in terms of instructions and everything. It's more of, referee science that I didn't want anything to get in there. They might learn that, hey, there's something weird going on in there, but it's not blatant in the instructions. Okay. I don't know if that.
Yeah, it's clear. No, because it was.
I'm guessing that they would be a lot more, right, this even makes it'd be even harder for the HFT if they knew there was an HFT there. Well, then they'll be more cautious. Okay, good one. Okay, sorry. So here's what I thought. Is there an effect on efficiency, which we talked about, volatility, meaning the variance in the prices, the bid-ask spread, which everybody looks at, that's where you can trade, book depth, how many orders are in there, and do the prices converge to equilibrium by the structure of the model, okay? And with HFT or just latency, right? Is there a difference between those? So here's the interface with latency. This is the buyer interface. Can everybody actually see this? It looks pretty, how do I put this? This is painful for overview. So over here, you'll see the value. So this guy has a value of 120, 110, 110, 100. So this is what he's seeing. These are the things he's bought at. He's bought at these prices, and here's the profit he's already made in this market. They see the trades that have gone on. They're already here at equilibrium. You see the last bid aspect. So this is an actual screen from an experiment. You can place, you can hit the market order, so you can buy at 80. You think it says, hey, it could change as soon as you hit it. And down here, you could submit an order. So this guy he's going to put a 74 in and try to slip in right in. Okay. Does everybody see this? This is what the screen looks like. You can see the cumulative, how much you currently made, what you do this period, what periods you're in, and how much time is remaining in the market. Okay. That's what that's supposed to capture. So anyway, and this is basic outcome from that particular piece there. Okay. So prices converge to equilibrium, you get the full efficiency. This is the latency treatment. This is what it looks like in HFT. Okay. All right. So on this side, this is a seller screen, but there are his costs, 30, 30, 40, so forth. These are the prices he sold at. Those are his profits. Cumulative, same sort of thing, except his is flipped, right? He puts in his sell order up here and asks to sell, and down here if he wants to do a market order, he can click on that. Okay. So what do you notice about this one? this screen right here. What's the main thing you notice?
Lower volatility.
Even something more blatant than that. Look at the number of trades. Okay.
Faster discovery of the equilibrium price.
We'll see if that occurs, but yes, but the volume is almost double. Okay. That means the HFT has been on both sides of those. He's doubling the amount of trades. Okay. So, if you're an exchange, do you like HFT?
Yes.
Well, there it is. That's why they like publication. That's why they'll give you this, they'll do whatever. They're causing all kinds of trade to occur on your.
They do actually pay rebates most of the time. So
Oh yeah, so that's a whole other story. So
yeah.
you know too much.
I'm
Okay,
sorry.
you know way too much. So exchanges to compete to get orders, there's things called make and take fees. So somebody who puts in a limit order that gets hit gets money back. It's a rebate. And the guy who hit the order took it in the market, has to pay it. Okay? So they're paying for
Volume.
whatever you're booked out, they're paying for limited orders to go in there. Because it would be very hard if you were an exchange and there were no limit orders in the book. How are you going to make a trade? So they like these people here. They think they like the limit orders in the book because that provides a lot of information there. That's why they pay them to put in if your limit order is paid. Right. So I think that's what you're talking about. They can take fees. I've done experiments on those too. Anyway, this is very interesting. So you saw a little lower volatility, but you saw this tremendous amount of volume here. Okay. That's what it looks like. But the efficiency is still high. So all these trades that are out here are just flipping, right? So they get the right prices, but a lot of these trades are just the guy making arbitrage profit. Okay, that's it.
Okay. Sorry, where do you see the arbitrage profit?
We'll see it later. You cannot see it. I'm just telling you, this is, if you were to look at this, okay, so if you were to look at this, you'd say, wow, this is a pretty inefficient market. Only, 20 to 25 units should be traded, and they're out there at 40, right? But many of these trades, right in between, you're like, each one of these is, buy, sold, buy, you bought here and sold here, right? So that trade is, there's only one trade there, really. One trade that's.
I guess the HFT that basically.
Right, on both sides. Yeah,
double the volume.
They double the volume, basically, just about. Not quite, but just about. Okay, so HFT increases volume, but doesn't affect efficiency. So this is the data here. So if you look here, trading volume under the latency is about 22 shares per period. It should be anywhere between 20 and 25. HFT is almost 38. Okay. Efficiency, you can't tell the difference here. So under the latency, efficiency, how much surplus is taken out of the market, they're almost identical. A little higher on HFT, but given the variance, no difference statistically. We can't tell. So it doesn't have any effect on efficiency. Okay, we can't find it. And this is lots of data, right? So it's 20 periods, 8 sessions. Okay, so think of it 20 times 8. No effect on bid-ask spread. So what we did here is we looked at the bid-ask spread and the amount of time that bid-ask spread was there. So the total time in the market is big T, the SI is the spread at that time, and how long that spread lasted. And so you can see the HFT has a lower spread, but given the variance, you can't tell the difference, right? And book depth is the number of orders you have in the book at any time. Okay, no difference there. So it doesn't have any effect on bid-ask spread, doesn't have any effect on book depth, doesn't have any effect on efficiency, tremendous volume. Is everybody with me here? I could give you all the stats associated with it, but I think you can just eyeball that. I mean, they're so close and given the standard deviation you're reduces trader earnings. Okay, by trader earnings, that means that the people who are trading in this make less money when the HFT is there than when they're just in the latency, okay? So all that means there's a transfer from the traders to the HFT, but it doesn't affect any other parts of the market at all.
No.
Okay. The average standard deviation of contract per period, you can't tell it, so there's no.
In your experiment, the traders is the buyer, the seller.
Right, those guys, they got the actual
The
human.
broker.
The human, yes, the broker. The human in the experiment. The people we actually paid. Okay, we didn't pay the HFT because that's us. So they made less money. Okay, and you know it's not a lot, but it's less. Okay, so the latency they're making about. So this is the total trader earnings per period. So this is total amount they earn per period. So you can see it's about
Less than
75. Yeah, but still, I mean, you know, I think if you were a trader, you'd rather have that. Okay, that's you. You're giving them. Okay.
How many agents, HFT agents, were considered? Just one.
There was no competition. We made it the worst case for HFT, right? So if we're going to find something, it's going to be in this one. So he's perfectly informed. There's only one guy.
So you didn't consider any correlation of behaviors between different agents acting like HFT traders?
Right. That was what we wanted to make,
Yeah.
but you're correct.
Okay.
But we can't even find anything here. I doubt. So that one would probably even, right? They're going to compete away those profits, right?
Also probably creating some strange effects on volatility and distribution of probabilities of the
Possible. Possible.
like fast crashes or.
Good question. Good question. We haven't done it. I'll tell you how we're going to do that a little bit here. Okay. I think. Okay. And then, so I'm done. And here it is. As expected, HFT increases volume and earnings. It doesn't do anything to reduce any of those other market quality things that somebody would be interested in. The question is that traders have options to mitigate HFT, so why don't they? That's the question. Right? They could go to different exchanges, they can just put in limit orders, they can do all kinds of things. They could go to Brad, Katsuyama, they could do it. So why don't they? That's the open question. Why is that not occurring? So there have been many, so there's a very famous study, I don't know if you guys know about this, but for a long time, the Tel Aviv exchange, the Israeli exchange, did not have continuous time. They just had 4 calls a day. They crossed the market 4 times a day. Then they offered some continuous trading in some stocks. Right now, all they do is continuous trading, okay? With HFT. Okay, so it came in and got rid of what you would think would be the most, for lack of a better term, the most level playing field.
Yeah, but I mean, from 4 a day to continuous, there is a huge amount of option that you can do. You can do 1 every 5 minutes.
1 every second if you want to. But here's the question. Here's the question. Okay. So a crossing market, right? Everybody sends in their limit orders. So all the buyers send in their limit orders, all the sellers send in their limit orders, and then you rank them. All the buyers high to low. You know, it's like, and you cross them, and everybody trades at the same price. Talk about no volatility, right? And then you do. So the question is, why do you need them? Why does one need continuous trading? Why can't you call? Is a call every minute enough time for liquidity?
Yeah.
Do you need every second, every nanosecond? I mean, so 4 times a day was good for a while. You know, in fact, it was good. Nobody was complaining until they offered this other, and then all of a sudden, oh shit, I like that. So there was a famous exchange called the Arizona Stock Exchange, done by Steve Lunch. It was after hours. It was a crossing. Okay. And it went away after about 4 years. And he argued that the people who sent their orders there said, well, I'd like to send it there, Steve. It's cheaper. There is no price volatility, but 70% of my orders don't get executed. Right? So if you send it in, the one thing that you can do with the you can hit the bid, you can buy and sell. You're done. You're out, you know? So there's no there's a little less uncertainty about the continuous one because I can just hit the, hit the orders, right? So, but the question is, why are there other offers of this going?
So what you're saying, in an auction process, the majority of the orders are not executed. You have a good chance of not getting your order done.
True, in a call, the one we were talking
in an
about.
auction,
Yeah,
or whatever.
yeah. Well, agreed. So the continuous time one is called a double auction. The other one is called a sealed bid auction. Okay, so they're both considered auctions, but I understand what you're saying. So an auction form. But on the other hand, there are many orders that are not executed on the New York Stock Exchange. They're still in the book. Many orders go away, right? It's just that in this one, you send it in, and then you find out later whether you execute it. Here, you find out, well, my limit order's with either I'm out or I might as well change mine. Okay? And they just find out lots of orders don't get executed, right? It's just what it is. There are lots of orders that on all these exchanges that don't get executed. It's hard to update, right? So there's some demand that's extremely hard to measure for immediacy, whatever that is.
And I just do Amazon.
Yeah.
Soon.
Right. But that's sort of the question I ask these guys. What happens if you didn't execute for another 10 minutes? Well, nothing. What does it matter whether you make the trade now or 10 minutes from now? What they don't want to is at the end of the day to not have done whatever trade they wanted to do. So they might have some other demands on their time or they have other things they want to do or whatever the case may be. But there are ways to limit orders. People don't like saying, so basically there are ways to try to minimize like the iceberg, or you would think there'd be a lot more of those. Not that many people do. So, they complain, but they'll do anything to mitigate. And so if you think there's unlevel playing field, literally, if you think that you can offer an exchange. Nobody's stopping you from creating an exchange. Brad did. That says, hey, mine is level. But nobody's going there. So it's a mystery still. Quite honestly, it's a mystery. So your arguments are correct. You'd say, well, hold it, that's now level. But there are so many other exchanges, so that's an open question. That's why I left with that. It would be very interesting to say, well, hold it, why don't we have competing HFTs? Because they're going to trade with each other, right? To try to get,
That's the most boring part probably of the argument. Just a lot of actors just jumping towards the others and doing the same thing, competing. It can become a complex, a chaotic environment, like it did sometimes. I'm talking about the fact that all the algorithms they move towards the same direction. They get the same signals. In the end, the liquidity of the market gets absorbed completely, and we might see some really weird behaviors in terms of price directions and all that stuff.
It's true. We couldn't see that. The story about this today. So you're an HFT. You don't care. Your algorithm is very simple. Hey, can I make some money off the trade? But if there's some other algorithm or whatever it is there that isn't an HFT, it just says, hey, the price is falling, sell. And then they sell. And then another algorithm says sell. The HFT is going to be in
It's
there.
like being short gamma every time. You sell when the market is going down, or you buy when the market is going up.
Right, they're all coordinated that way. But the HFT is just in there.
That happened already in 1987.
Right,
for insurance programs.
Right.
But this gets more frequent probably now. There's someone who has a website that studies all the Fresh Crashes episodes during the day. I can't remember the name of the website, but it's very interesting. He tries with some algorithms to recognize
whether it's this contagion in the sense of all the algorithms are trading at the same time.
I think that's the most important part of this phenomenon. Not the fact that the fund managers are losing a bit of money when they send orders to the market, because they would lose it anywhere when they would send orders to specialists in New York.
Sure.
They would keep
sure.
the market very
well, they were the
like
original.
Safari, 20 years ago.
Yeah, they were the original HFTs.
Exactly. They were with the strong latency, but anyway.
Yeah, strong latency.
But what really worries me is just the potential disastrous effects that might happen on the market when everybody does the same thing, in an automatic and uncontrolled way in the end.
Well, true, but a lot of these, when they trace them back, it actually goes back to an individual who did something incorrect.
Fat fingers.
Not even fat fingers, like the big whale guy, the one in London who corrected that person. He had a big work. It was one guy that caused this thing to keep going in that direction. The thing that would be there is now there are a lot of services that stop you from doing that, right? They have all these. They'll say, hey, don't plunge, right? Because these algorithms, they're not looking. They just do. Well, hold it. If you have a momentum one, it says the price goes up high. You buy until you spend, you keep buying and buying and buying. Well, if everybody's doing that, right? So now they're learning too, as you might suspect. So yeah, we haven't done those, but those would be quite interesting. We want to have a tournament of people putting in their algorithms and playing that sort of thing. So anyway, that's the sort of question I'm stuck with. I have no answer. I'm going to run some experiments where people can route their orders to crossing markets and see if one takes over the other. They can live mutually or however. But I haven't done it yet. It's interesting to me that everybody knows this occurs. They complain, yet they send their orders there. But it's not surprising that the exchanges lack HFT. There's no question. They pay for services, they increase volume.
How's Katsuyama exchange doing now?
It does very little volume.
Yeah, that's the point.
Right.
It's fantastic,
Yeah. It came here to do this. It came to do exactly. I'm leveling the playing field. In fact, that's the term they use right at the front of it. What's IEX? I think it's IEX.
I don't remember, yeah. There was an S inside, so it was tricky in the website main language.
Yeah.
Sort of sex exchange.
But it has volume, but it's very low. I mean, obviously. Right. So what he does is really interesting. It still looks like a regular exchange, except it has a coil. It has to. It slows everybody down.
It allows you to set orders in the same time.
Right.
Everyone. All the agents to do a right market at the same time with a sort of mechanism that stops the fastest.
Right. And yeah. Exactly.
So that's interesting.
So yeah, that's the interesting part. So it looks like the regular exchange just slowed down. Of course, you wouldn't know it's slow if you're human. The computer might know it's slow. So anyway, that's all I have to say today.
It's still amazing how Japan or Citadel make money in this business. It's a huge amount of money. I mean, Ken Griffin last year paid off a bonus of $1.4 billion by himself. I mean, that gives you an idea of how big is this business going.
Yeah, but you would think though that there must be something in his secret sauce algorithms that different than other people because there's a lot of HFTs. They all compete, right? So you would think the profits would be competed away somehow, but he has some special
smart.
Yeah. So his algorithm is, better than everybody else's because it's not like this, right? So this is a stripped down, most powerful version for an HFT. One guy who basically can do whatever he wants. But these are all probabilistic. You don't know the order what that is, and you've got to get in front of it at another exchange, given the latency tables. So that's a tough problem. So unless you really know what you're doing,
it's all about machine learning, bro.
Yeah. I don't know what they do. I'm sure they're not going to tell you.
I
wish. Yeah. Any other questions?
Go ahead.
In my opinion, the need for continuous trading comes also from the theory of derivative securities. The theory says that you can price a derivative asset only if you are able to intervene exactly and immediately at that price, that given price with all the figures instantaneously. Otherwise, you are not hedged in some way. Therefore, you have to be able to interact with the two markets, the one of the primary securities and the equity, and the derivative market, in order not to have some arbitrage. And in this respect, I think that some of the algorithmic trading that you have presented do not only deal with the primary securities, namely equity essentially, but most of them try to cross the two behaviors of primary and derivative securities. So also some other possibilities of arbitrage that are given by HFT programs involve also the derivative market.
They do. There's no question. It's true that all the models for derivatives require that have volatility in it. So if there's no volatility, there's no, right? But there still has to be arbitrage, right? So it's not that you can't coordinate call markets. That my order here is contingent on this order here, right? So you can try to do those. No, they're a little bit more complicated, but you could do that. You could still have, you can still have the continuous derivative market and still have the call here, so you can still hedge, right? Based on what you think the price is. If the price is this, I can do this over here, right? So you can coordinate your orders, but you can hedge still. But I haven't thought about that one, that in fact, you need this continuity across markets, okay? We only have one market here, so somehow to create that to see if that's the reason for it. But this occurs even in markets that, I'm going to put it, the derivatives aren't of any major consequence at all. They still, they like a continuous market. For example, trading pollution permits. In Southern California, they do it continuous, even though the call market went away. And there's no derivative market for that. But that's a good point. I think it's an excellent point.
Yeah. I'm an options market maker, and that's the main worry we have. It's the presence of these agents, HFTs, actually do provide some distortion to the probability distribution that I input into my models in order to basically price my options. That's my main point. Since 2006, probably 2005, the market has changed the way you have to price, for example, deep out of the money options because of the possibilities, which is more likely to have events that actually bring you there. So this creates some effects on probably higher momentum of distributions that we actually need to price in. So it's difficult to understand how much you have to.
I guess, but is that, but going back to your original question there, is that the reason why they need to be continuous?
Oh, sorry, thank you.
Oh, thank you very much. Okay.
Yeah, that's a point.
Yeah, so I think that's it's valid. I don't know.
You mean the primary market or the derivative market, the continuous? And you said you are claiming that there are no needs for the derivative market to be continuous.
I think your argument was that all the models for pricing the options require variance. Okay, that's sort of the big thing that's in there. But if markets are clearing at the same price, there's no.
No. I was not saying.
No, I know. You're talking about that you need both of them at the same time.
Yes.
And you need to see the two prices, right?
Yes.
So think about the following. So that's a great question. So think about the following. You still have a call market, which is open. You can see the orders forming, right? So you can see, wonder if it's a real-time crossing market. You see the orders come in, you see the current price here, you see the current price here. It's just that you can't execute them at the same time, okay? That's what you're saying, is that, with the continuous market, you see this price here, you see this one, if there's a difference, I execute them both at the same time, correct? So the only way to do that with call markets is to send in an order that says buy and sell at these two prices, contingent. If this one's filled, then that one has to be filled. If not, neither, right? One of those. Correct? That's sort of that's the issue, right? No, I got you. I got you. Did you learn anything? A little bit.
No, I was considering that we're talking about seconds or not seconds. And this morning I gave order to a bank to make a transfer money order to the United States, and it will be executed in 4 days.
Yeah. Okay, that's not HFT.
They won't accept anything in 4 days.
Yeah, that's different. That's the banks over there.
Okay, usually at the end of the seminar, I ask you for intervene, but I have the version this time. We don't need to ask. It's in the beginning. Okay. It's okay, perfect.
Okay. All righty.
Thank you very much.
Thank you.